Most Australians earning $85,000 a year will retire with less than the person next to them earning $65,000. Not because of bad luck, because of sequence, because of order, because one of them knew what to do first. This is the exact order. Here's the actual problem. It's not that Australians don't want to invest, and it's not that they lack income. The median full-time wage is sitting around $85,000 right now. That's real money. The problem is that start investing is not an instruction. It's a category. It's like telling someone to get fit. Technically accurate, completely useless. What does investing actually mean on a Tuesday after paying rent? Open which account? Put money where exactly? Super or ETFs? Emergency fund first? Mortgage offset? The reason most Australians with decent incomes end up with weak investment portfolios has almost nothing to do with intelligence. It's because they never built a sequenced decision tree. A clear order of do this first, then this, then this. So that's what this is. 6 stages, real numbers, real Australian platforms, in order. Stage 1, kill expensive debt. This isn't motivational, it's mathematical. Afterpay, zip pay, credit cards charging 20%, personal loans at 14%. These aren't debt products, they're wealth destroyers. You cannot out-invest a 20% interest rate. The ASX has historically returned around 9 to 10% annually, including dividends. So if your credit card charges 20%, you are mathematically losing. If you've got $2,000 sitting in savings earning 5% while carrying $2,000 on a card charging 20%, you're going backwards every single month. Step 1 is not exciting. It is non-negotiable. Pay off every consumer debt above roughly 7 to 8% interest. Highest rate first. HEX is different. That's a separate discussion. But consumer debt comes first. For most Australians carrying revolving debt, this alone will outperform almost any investing strategy. Stage 2, the $3,000 buffer. Not 3 months of expenses, not a massive emergency fund, just $3,000 in a high-interest savings account, ING, UBank, or similar. Why $3,000 specifically? Because most financial emergencies in your 20s and 30s are not catastrophic. They're friction events. Car repairs, emergency flights, a broken laptop, unexpected medical bills, a week without income, without a buffer, those expenses go straight onto a credit card, which sends you directly back to stage 1. $3,000 is the minimum viable safety net that lets you continue investing without constantly resetting your progress. Put it in a separate account. Name it something boring. Don't touch it unless it's a genuine emergency. This is not your full emergency fund. That comes later. This is simply enough padding to stop life from knocking you backwards. Stage 3, super and actually using it properly. Most Australians in their 20s massively underestimate how powerful superannuation is. It is the most tax-efficient investment structure available to most Australians, and almost nobody optimizes it. The employer contribution is currently 11.5%, moving to 12%, but most people stop there, and that's where they leave money on the table. Salary sacrifice contributions are taxed at 15%, but if you're earning $85,000, your marginal tax rate, including Medicare, is roughly 34.5%. That gap matters. Every dollar salary sacrificed into super instead of taken as income saves roughly 20 cents in tax before investment returns even begin. Adding just 2% salary sacrifice on an $85,000 salary means significantly more money invested every year automatically. Inside super, choose a low-fee, high-growth indexed option. Australian Super, Host Plus, Australian Retirement Trust. Most major funds offer one. And check the fees carefully. Anything above roughly 0.6% annually is probably too expensive. This stage is not glamorous. It won't make you feel rich overnight, but it will likely become the single biggest driver of your long-term wealth. Stage 4, your first real investment account. Now we actually start building wealth outside super. Open a Perla or Shareseize account. Both are built well for long-term Australian investors. Then automate $200 per week into VGS, the Vanguard International Shares ETF. Why $200? Because on a median Australian income, it's achievable without destroying your lifestyle. That's just over $10,000 invested annually. If you start at 30 and continue for 25 years at historical market returns, you're approaching $1 million. Not through stock picking, not through crypto, through consistency. Why VGS specifically? Because it gives you exposure to roughly 1,500 companies across developed markets, the US, Europe, Japan, and Canada. You're not betting on one company or even one country. You're betting on global capitalism broadly. Historically, that's been a very good bet. And this next part matters more than almost everything else. Automate the investment on payday. Not when you remember, not when markets feel safe, on payday. Because automation removes emotion from the process and consistency matters far more than timing. Stage 5, mortgage offset or full emergency fund. If you own property, direct additional savings into your mortgage offset account. At current mortgage rates, that's effectively a guaranteed after-tax return. Very difficult to beat on a risk-adjusted basis. If you don't own property, build your emergency fund from $3,000 to roughly 3 months of expenses. For most Australians, that's somewhere between $8,000 and $15,000. Keep it liquid. High-interest savings account only. This money is insurance, not an investment. And yes, this stage comes after you've already started investing, because delaying compounding early can cost more than temporarily carrying a thinner cash buffer. The goal is to start the compounding clock as early as possible while still managing real-world risk. Stage 6, review and scale. Once the system is running, sit down every few months and review the numbers. What percentage of your income is going toward productive financial decisions? Debt reduction, investments, super, offset. Most Australians save somewhere between 10 and 20% of income. The people who build serious wealth gradually move toward 25 or even 30%. That does not mean living miserably, it means controlling lifestyle inflation as income rises. When you get a pay rise, split it. Half improves your lifestyle, half increases investments. So by the time you're earning $100,000, your weekly investment should probably be closer to $300. At $120,000, maybe $400. The investment rate scales with income, and this is also where revisiting super contributions becomes important. The higher your income climbs, the more valuable those tax advantages become. So what does the full sequence actually look like? Eliminate expensive debt. Build a $3,000 buffer. Optimize super. Invest $200 weekly into VGS. Build your offset or full emergency fund. Then review and scale. The person who follows this sequence on $85,000 will usually outperform the person earning $95,000 who skipped the fundamentals, bought random crypto, and keeps meaning to look into investing properly later. Because wealth creation is usually not about finding perfect investments. It's about doing the right things in the right order consistently for a very long time. The maths is not complicated. The sequence is not secret. What's rare is following it long enough for compounding to actually work. A few honest caveats. This assumes relative employment stability. It assumes you're not heavily leveraged across multiple properties. And the $200 investment figure is illustrative. The right amount is simply the highest amount you can sustain consistently without breaking the habit. Different cities, different incomes, different life situations. The details change, but the sequence largely holds. And honestly, if you've delayed investing for more than 6 months, it's probably not because you need more information. It's because invest is too vague to act on. Open Perla. Connect your bank account. Set $200 to auto-invest into VGS on payday. That's specific, that's actionable, that's something you can do this afternoon.